Good morning, everybody, and welcome to our Future Proofing Your Business webinar, hosted by Farnell Clarke and special guest Tina Cornfield. We're going to sort of talk about different aspects of future proofing your business, everything from funding right through to planning. So we're joined by Justin here from Farnell Clarke, who's going to talk us about everything funding. Tina is joining us from Complete Financial Centre, and she's going to talk about insurance protection. And Patrick's here to talk about planning. So without further ado, I'll introduce you to Justin to talk to us about funding.
Hi, good morning. Thanks ever so much for that, Rebecca. Morning to everybody. Lovely to have you join us this morning to have what is, relevantly speaking, quite an important topic to cover. Very simple, my CV, 30 years in structured funding, working in the litigation and accounting arenas in that time. So a little bit of experience, hopefully to bring assistance to clients, both new and current. And old, obviously, to see if we can assist you at this time and indeed going forward, more importantly. Rebecca, can we have the first slide, please? So currently where we are, what have we had in terms of support given this most dreadful situation? We've obviously had furlough payments, grants, VAT deferrals, which have been very useful and a bit of a godsend to many. Bounceback loans, CBILS loans, and the C-bills, the CL bills, the larger bounceback facility loans provided by the government, and of course corporate and personal tax deferrals. So the government have done, I think, it's fair to say, their best to try and assist us at this time, all being that it all came as quite a surprise, and it certainly wasn't something that was necessarily planned. But anyway, that's what we've had so far, and that's kind of where we are. That's just kind of a nod to the current situation. Next slide, please, Rebecca. Just in case anybody doesn't know, the bounce back loan scheme obviously is provided by the government for, I think, from £2,000 to £50,000. The application process is relatively simple and straightforward. In addition to that, they have the C-bills loan, again, from 50 grand to whatever, 5 million. And then you have the CL bills, which is for the larger C-bills requirement funding. Again, readily available, but obviously it's a far more complex process of application than in the bounce back, which is literally a couple of buttons, a number of questions, and if applicable, you can then qualify and its money's transferred. Moving on to the next slide, please. Yep, in focus, bounce back 2,000 to 50,000 without director's personal guarantees. That's quite an important factor because obviously that reduces your own personal liability, which is always a good thing. Rates are extremely good, 2.5%. Fixed term, 6 years. There's nothing to pay for the first 12 months, and no capital, no interest, which again at this time could be the difference between continuing trading or not. And then obviously after that, the payments would start kicking in. So month 13, your first payment would commence, commensurate with the amount that you've borrowed, and that will be for a remaining period of 5 years. No upfront fees, no early settlement fees, and typically, well, not just decision to draw down is something from 24 hours, as quick as I've known, through to 48 hours. I have one client who rang me on Friday and then sent me a text on Sunday and said he had the money in the account. So it's a very quick process. Next slide, please. C-bills, which obviously is, as I said, mentioned earlier, a little bit more complicated. Borrowings 50 to 250. Again, 250 is stated. You can obviously borrow further above that, but up to 250 is without personal guarantee. Again, mitigating of risk. It's always best to try and keep it within the realms of your personal exposure. Rates will vary, 1.4 to 8.9%, depending on lenders. There originally were 40-ish lenders that joined the panel of approved lenders. That's now been increased out to cope with volume and supporting as many different underwriting disciplines and requirements as possible, trying to make it fit all rather than just fit some. Again, terms from 2 years to 5 years. Again, nothing to pay for 12 months, no upfront payments, no early settlements. Acceptance time is about 3 weeks, but of course then you have the contractual side, the paper side, and drawdown, which may take a number of weeks thereafterwards. So A slightly longer process, a lot more detail will be required. We'll need to make a full business plan with 3-year cash flows, show a lot more planning, a lot more structure, and a lot more guidance of the pen, which is where Farnell Clarke have excelled so far, is providing that additional level of support to help the client produce a representable and solid presentation bundle for the funders. Next slide, please. Just to give us an idea of where we are in terms of who and what has been borrowed, Bounceback loans, which we mentioned earlier, up to 50 grand. Cumulatively, we've lent circa 34.34 billion. Number of applications approved so far, 1.14 million. Which I was a bit surprised at the number of applications they've received are about 1.4 million. So even on the Bounceback, there have been ones which have either not proceeded or failed for some reason. Could have been that they wanted the money for outside the UK, which obviously it needs to be money for the UK. Has been one of the criteria. C-bills, 13.08 billion that has been put out. That equates to about 58,000 applications approved, and obviously cumulative number of applications received 119,000. So obviously there's some more there again that have either failed or that haven't come forward yet to draw down. And for the larger C-bills, which again has been less prevalent, but you're talking about many millions of pounds, we have lent as a country 3.27 billion, which equates to about 482. So you can see it's quite a massive reduction, less of that sort of level of borrowing into, or sorry, that level of client that's borrowing that sort of magnitude of funds. And again, 887 applications received. We're getting sort of indications that we're running on C-bills of about just under 50% acceptance across the board. So it's not a guaranteed process, but of course, life, as everything else, isn't a guaranteed process. We can only just do our best. Next slide, please. I'm sure a question which would come up, certainly one that I've asked, when will these facilities end? Bounceback is rumoured to end on the 4th of November. The C-bills is rumoured to end on the 30th September, so all orders in before then. And obviously for completion, drawdown and the wiggle room, I guess, they've extended out to November 2020 to allow the completion and drawdown facilities of those approved. Again, these could change. This has all been a series of flux for us all. But anyway, that's the sort of the guideline dates that we've been given so far. Next slide, please. So when we've nodded to the past. So in acknowledgement of where we are, obviously funding historically prior to C-bills was moving along at a pace. Businesses were going well. The trends were looking good. C-bills has come along and frankly been quite a tsunami. The effect of that going forward, there's obviously will be less funders out there, or at least funders with maybe a reduced appetite, which obviously there's the first one that I've put on there is lending appetite. Underwriting attitude, what they're looking at in terms of risk assessment and stress testing, that will no doubt be redefined by all of this, buy-to-let markets through to commercial, etc., because we've all seen how the slip and the change of properties and usage of properties has gone in the last 6 months. Security itself, i.e. what we're offering as security, will they need additional? Will what we're offering be sufficient? Will the valuations come in correctly, given again the movement in values of properties? How we approach further future borrowing is also a very important factor, because we'll have to give consideration to the fact that we borrowed Bounceback money or borrowed Sybil's loan, and how the lenders will view that in time to come, and how that will affect obviously your balance sheet and your general exposure as a business. And indeed, more importantly, or as importantly, is our approach to lenders. How we present the information to them, I think, will need to be in a more detailed fashion than perhaps historically has, and with more reliance and requirement to produce detailed, structured plans, number one, and detailed and structured and focused cash flows, number two, management information, which will be the sort of the two key parts to the process moving forward. Next slide, please. What can Farnell Clarke source or assist in the sourcing for you? Obviously, asset funding for soft and hard assets. What I mean by that is a car as a hard asset, lorry, a computer as a soft asset, as is air conditioning. So we can find funding for those type of assets within your business structures. Cash flow funding, CHOCs, client-held owned cash, which is basically factoring, etc. So we can assist with that. That helps with cash flow and maintaining the business's income stream to make sure that you still thrive and the business still progresses. Merchant services, which again, for probably the smaller retailers who have card machines and run their card through, we can generate funds against your card and your takings on your card machines. FX trading for those of you who are trading overseas. Setting rates, etc. Business loans, which are dissimilar to any other loans that we've had historically in the business sector, either secured or unsecured, directors' guarantees, debentures, that sort of, in terms of security, that's the sort of requirements they will have. Business overdrafts, we can obviously speak with the banks and work with you to obtain overdrafts to support applications by way of written testimonial, etc., and application. Commercial property funding, which again we touched on earlier for buying buy-to-lets, etc. Development funding for those of you who are developing housing association properties or building actual 3 or 4 flats. We can provide the funding. We can work with you through the structuring of the planning, through to the deployment on site and the actual structuring of the funding and working with the funder to make sure you get effective and efficient drawdown. Bridging, which is again a simple product. Buy a property at auction, we can assist with bridging your exit being either a sale or looking to remortgage it at a point post the auction, and therefore settling out the bridging facility which you have. Buy-to-let mortgages for tenants and for renting out, and HMO again for affordable renting, etc. for tenants effectively. So quite a general mishmash of funding, and everything that may appear in between investors or people with angel funds that want to have a chat. There's various connectivity between ourselves and a client base, so we can draw in support that may help you. Next slide, please. So sort of in close, so we've secured loans. Potentially a number of you will have done Bounceback. I presume that's why you've had a look on here today. You're looking at the fact that you've had the Bounceback or Sybil's, or you're in the process of looking at them, or you have about to take it to draw down. The key factor to this, as I kind of punctuated through this, is planning, is protection, to make sure we future-proof our businesses and ourselves and our families, more importantly, or as importantly. With that in mind, we've got insurance and planning, more specifically insurance with Tina. Tina, if you'd like, thanks ever so much, but if you'd like to take it forward and have a chat to us about all matters insurance, please.
Hi, thank you. Thanks, Justin. Yeah, my name is Tina Cornfield, and I've been in the financial industry for the last 23 years, specialising in all types of protection. Now, one of the things that we've, as Justin has said, the coronavirus business interruption loan, CBILS. If you could go to the next slide, please, Rebecca. Now, as you can see, businesses have borrowed money using that scheme, and that money has got to be paid back. So what I'm going to do is I'm going to do it as an example. So you've got a business that's got 3 directors, directors A, B and C, but how will the businesses cope with this? So the business borrows 50,000 from the CBILS scheme, and they use that money to make the business coronavirus proof. However, the business isn't operating at full capacity, and therefore it's not profitable at this time. So it's unlikely that the business will survive without further cash injection. Next slide, please. So to keep the business up and running, one of the directors, Director A, has injected his personal savings into the business as a director's loan. But let's say, for example, Director A dies while they are paying the CBILS, and the business still has the director's loan. What happens now? Well, Director A is part of the sales division for this example, and he accounted for 50% of the sales and profits of that business. The estate of Director A now owns 33% of the business, and they have the right to call in the director's debt immediately. So where does that money come from? The business is a further 50% down in profits due to the death of their sales guru. The bank will not lend them any money, as confidence in the business is now wavering due to lack of sales and underperformance. So the business also needs to replace the director with someone who can pick up the slack on the sales side. Next slide, please, Rebecca. So what happens now? Well, Director A's estate, or what could happen, will recall or could recall the loan immediately. They're entitled to 33% of the dividends. They can make the decisions on the business's behalf. So let's say somebody is a builder and their wife is a housewife. Well, obviously, say he was in partnership with two other builders, they're not really going to like that. And they can sell the shares if no business will is in place, and they can veto major business decisions. So next slide, please. What happens then? Well, the business gets liquidated, the staff lose their jobs, the directors would have to start again, and what if any of the loans were secured against personal property? And the surviving estate gets a marginal payout at best from business that Director A built up from scratch. So, next slide, please. What does this mean for the business? Well, they now owe the estate money. They're 50% down on profits and they can't afford to pay themselves through dividends, as they don't want the estate to benefit from the dividend payments. And the estate can actually now start legal proceedings for two reasons: unpaid debts and unfair prejudice. So next slide, please. So what's the solution? Well, Sybil's loan protection, 50,000 to pay off the loan. You can have shareholder ownership protection, and that means there's sufficient cash flows to say there's three times 33% cash flow to buy out the surviving estate. Director loan protection, there's such a thing called cross-option agreement, which has to match the articles of association, which gives a first option of sales purchase that goes to the other directors, or key person insurance, which covers at least 50% of the profits brought in by the sales director. Now that will allow the business to have sufficient cash reserves and breathing space to find a replacement. Okay, so that's the Bounceback loan protection. I'll now go on to relevant life plans. Now, these are single life, standalone death in service plans. Relevant life plans are covered by the same legislation that deals with group schemes, but unlike the schemes provided by most big employers, they're non-registered, so they don't fall under pensions legislation. They provide life cover through a discretionary trust for the benefit of the employees and directors' dependents. They're taken out and paid for by the employer. Next slide, please. So who's eligible? Well, any employee or director of a limited company, partnership, charity, or a sole trader can have one. Okay, however, you should check with the provider, as some do not cover sole traders or equity partners where they're taxed under Schedule D. Who are they for? Well, they're for small companies that don't have enough members for a group scheme, high earners who don't want their group death in service lump benefits included in their lifetime pension allowance, and employees looking to top up the benefits they get from their employer's scheme. Now, this next slide is probably very important. Why are they tax efficient? Well, the employees, they don't have to pay income tax on the benefits, and they're not usually subject to inheritance tax. And unlike lump sums paid under a registered scheme, i.e. relevant life plan, they don't form part of an employee's lifetime allowance for pensions. So next slide, please, Rebecca. Now, the treatment of the premiums. The taxman doesn't treat the premiums paid by the employer as a P11D. Now, for higher rate taxpayers in a small company, this can reduce their costs by up to a third. Neither employee nor employer has to pay national insurance on the premiums. And so long as the company's accountant and the local inspector of taxes are happy that the premiums are wholly and exclusively for the purposes of trade, as part of the employee's remuneration, they can be treated as a trading expense. And the premiums don't count as part of the annual pension allowance for tax purposes. So on the next slide, we've got an example. And that table shows the effect of the company paying for an ordinary life cover and having it treated as a benefit in kind. And then it looks at a relevant life plan, assuming it qualifies for tax relief. Okay, right, and can these plans be used for business protection? No, they can't. The legislation states that the primary or main purpose of a relevant life plan must not be for tax avoidance. And to qualify as a relevant life plan, a plan has to meet certain conditions. It can only provide life cover, although there is one particular provider or maybe a couple out there who will do significant illness cover. The term can't go beyond the employee's 75th birthday. There can't be a surrender value, and the benefits must be paid to an individual or a charity or to a trust, and it mustn't be set up to avoid tax. Okay, that's it. So hopefully that's been of some help in these awful times.
Excellent. Right, well, thank you very much, Tina. My name's Patrick Levy, and I work as a virtual CFO or virtual FD at Farnell Clarke. I do monthly management accounts for clients. Forecasting and planning is a big part of it. Cash flow forecasting, governance style stuff, like your company's house kind of filings and ownership of the company, all the way through to help with selling the business. Overall, basically making from your finance department through to the entire company running more efficiently. So we move on to the first slide there. Thank you. So I'm going to be talking today in very general terms, basically about why you should be planning ahead. Some people in this situation with the crisis that's hit us would say that it's also uncertain. It's all so uncertain that why really should you plan? It's kind of futile. I'd rewind from that a little bit and start by saying, first of all, do you know your numbers properly? As a business owner, you not just should, but you must. And that starts before planning. That starts with just having regular accounts every month that have been reconciled by an accountant and make sense. So you can keep track of performance and know exactly what's going on in your business. The importance of forecasting. So now we get on to, well, why should you really be planning? Well, first of all, it's a case of, instead of just looking at the current situation and then having a vague plan in your head, it's about looking forward and proving your various hunches and intuitions through numbers and getting them into a plan. Another importance of forecasting, as I'll come to later in another slide, is about just having that time away from the actual coalface of the business. So as opposed to doing what you do best, which is dealing with customers directly and getting new customers, all the fun stuff, it's also really important to step away occasionally and get that planning time. Another importance of forecasting is to realize that it's not about getting 100% accuracy. Particularly, as I mentioned, with these very uncertain times, you're not going to get that. It's often said of plans and forecasts that they're always wrong. It's just about reducing them to be the least wrong possible. But again, it's about looking forward, not just at your current situation. Now, this third point here is saying that we do acknowledge that everybody plans. Everybody is planning. So I'm not going to stand here and say that business owners are not doing any planning. That would be foolish. You are planning, but what most people don't do is then formalize that and take it forward into a full financial plan. So it's just that next step. So you do have plans, but they may be mostly in your head and they're not projected forward in a plan. The other reason why you should plan is to get the full picture. That would be because probably mostly plans are in terms of possible sales. There might be some costs you've thought of, but really you have to think about the full picture. And when we as accountants think of the full picture, we think of what we call a three-way forecast. So you've got your profit and loss, which means trading, your trading accounts, so what you're doing business month to month. You've got your balance sheet, which is a snapshot, just your scorecard of where you are, which the profit and loss feeds into. And then you've got your cash flow. So if you've got those three planned out, then you really do get the full picture, as opposed to just looking at one element. And why should you plan? Well, the whole point is to get a return from it, and that should be to increase the bottom line of the business. I put that in here to say that a lot of people focus on increasing sales, thinking that if you increase sales, that equals growing the business, and growing the business means being more successful. There is truth to that, but it's just a danger that you can not focus on the bottom line. It's important to translate those sales into profit. In other words, control costs and not let it run away with you. And the other one, of course, is, you know, you're running a business for a reason. And that's because to support yourself, to support your family. And lastly, over on the right-hand side there, I don't know if anyone's seen this written. You guys, you know this one, the old sales is vanity, profit is sanity, and cash is reality. It's a bit of a corny cliche, but it's true, I'm afraid. So if you can at least get down to the profit one and wean yourself off just looking at sales, then you're doing well. And then, of course, cash doesn't follow the nice, neat pattern of your P&L. So that's the reality. So let's move on. So first of all, I'll just talk about some of the negatives, in other words, the pitfalls, and then we'll move on after that to some of the more positive stuff that comes from planning. So I've just got a few examples here. At its most basic, it would be just not seeing your VAT bill coming. It's a classic. If you and also your corporation tax there is the second one down there. VAT is paid 37 days after your return is submitted, so there's a gap, so you may just not quite have planned for it. Even worse is during the lockdown, everyone got their VAT deferred, so that could be a small-ish figure of 5 or 6 grand. If you're a bigger business, it could be 75 grand, and you need to be ready for that to hit your business account and to be paid. So that's a simple example. One that recurs every year for everybody is corporation tax. And the problem with that is that it's based on last year's figures, or the further away you get from it, you're looking back to when the actual amount was generated, and you're going to pay it 9 months later. So it's important to be planning ahead so that you can see that. And lastly, just to say that if your version of forecasting or planning for the business is just looking at the bank balance as you go along, you're missing out on all the possible data actually that's in zero in your accounts. All your bills and your invoices, they've all got due dates on them. They can be used to show when you will actually part with that cash or receive it. And also, as it says here, the past does not equal the future. If you were doing very well before the coronavirus and then it suddenly struck your revenues, then of course you can't base your assumptions on how things used to be. Right, so let's go to the next one there. So that's some negative stuff in terms of just what you need to look out for to not trip up on. In terms of opportunities, this is where I really come into my own, because any kind of financial plan will show you your liabilities and show you all the stuff on the last slide. Where you can really start to get a return is when you really rifle through your entire business and go from the ground up and just work out what drives your business. What are the things you do that actually make a difference? And what are the things that you don't do that you should? For example, you could be looking at your current staff levels and saying, well, what could I be achieving with them before I need to hire anybody else? Am I maximizing things? And that will come from a long conversation about what your staff do, what you do, what the interplay between is that, and how the market's playing out. Just looking at your current plans. So before getting into any wild speculations, just if you just play out the current situation into the future, does that work? If you put in future liabilities, is it enough? Even better, when I work with clients, I tend to look at targets for ideal situations. So you start off by saying, how would you like this to end up? And you can plan that out, and then you can see how far away off you are from that. So you could, if you're a business owner who pays via dividends, you could say, well, I want to be drawing X amount a year to live on, and you draw them from profits from your dividends. So we would plan it out so you get a target profit amount and work backwards from there. So that's one way of doing it. Beyond that, it's about efficiency. So looking at all of your processes, we provide a process mapping service where we can just talk through how you do things, and you just spell out who's involved and what happens and why they do it. And we go through all your processes, and we can see in different areas where you could be doing things better. That's not always from using flashy software. It could just be how people are operating, but sometimes it is a case of changing systems. And lastly here, it might all sound very nice having some target condition that you want to get to, but it might just seem like a pipe dream. That's where the planning comes in. We see how quickly can you get there. Do you have to be patient, or should you be stepping it up? And we could be doing better. So next one here. So I suppose the next question is, if while I've been talking, you've been accepting that planning sounds like a good idea, the next question is, well, why plan then with your accountant? The reason is because, first of all, it's, as I did mention before, that it's an opportunity to step away from your business and work on the business rather than in the business. So it's that other space. And married to that idea is the fact that if you're working with someone like myself, for example, after you've been working with Justin and you've got a loan and you've spoken to Tina and you've got the correct protection in place, then planning is this going forward, this process of sitting with someone else who is not in your business. It's hugely valuable to be sitting with an independent person who's not doesn't work in your business, is not employed in your business, doesn't have any involvement in any of the politics in your business or anything like that. So they're completely independent and they're a finance expert, and you get that outside perspective to try and help improve things. So it's that sort of neutral space to work on your business. And the last point here, which I'm going to elaborate on in the next slide, is if you have that accountability partner, that really will help you reach your goals. And I'm not just saying that, because if you move on to the next one there, Rebecca, this is from I've seen this in my work anyway, and throughout the industry. So people who do planning, people who do my job know this anyway from experience, but this is a scientific study that showed the power of accountability. So you are 42% more likely to achieve your goals just by writing them down. So the first slide I was talking about said that you do plan, but you're probably not formalizing it and taking it forward. And for a lot of people, that means that they're running the business in their head. And for a lot of people, that kind of works. It keeps them out of trouble. However, if you actually want to improve things and reach your goals, then you're in the region of 42% more likely to achieve that just by writing it down. But look at the next one, 78%. So in that kind of high percentage, more likely to achieve your goals with an accountability partner. Anyone who goes to a gym and has a personal trainer will know what that's all about. But I'm here to say that in business, it's the same thing. If you step out away from your business, sit with an independent person and plan, you're more likely to achieve your goals. So how do we relate this to future-proofing your business? Well, if you've got the funding in place to actually enable things, if you've got the protection in place to protect you, and you're planning to be able to chop and change with the uncertainty that is ahead, then you're standing yourself in very good stead to future-proof yourself.
Great, thank you everybody. Some very interesting discussion points there. Justin, would you say that everybody's approach to the bounce-back loans and the C-bills has been a reactive one perhaps, and that, you know, we've taken the money because it's been there on offer? Some may put it away for a rainy day, whereas actually what they've borrowed may not be enough. And how do you think businesses are going to cope with needing further lending versus whether or not they can meet those repayments in the future?
Well, that's a very good question with quite a number of different departments. Borrowing the monies, why have people borrowed the monies? I think in we've obviously looked at quite a substantial number of clients and spoke to a lot of clients in respect of both Bounceback and Sybil's. The requirement in majority of them is need, which is being promoted by the fact that they're unsure how the business is going to respond. If we look at the hospitality area, that's been obviously quite hit by the process, and continually going forward will be hit by social distancing and a requirement for less people in the same space. So if you do 50 covers, you suddenly can only do, I don't know, say 20 or 25. So obviously your income is restricted. So I think people are looking of ways and finding ways to support the business through this time, which is the purpose of the Bounceback and Sybil's. It's to sustain the business throughout. So you have a working cash flow that sort of brings up the deficit. In terms of the long-term reality of paying it back, I don't think as many people have given consideration in detail, which obviously we try and implore that on people we speak to say, look, you are going to borrow the money. In 12 months, it will need to be paid for. How are we working towards it to make sure that there's going to be cash dependency, so cash availability within the business to make and to service that debt? Conversations then come with Patrick, etc., where the clients sit down and they're working on a strategy for the business to sustain itself and obviously grow post-COVID and hopefully stay in place. I mean, it's quite a challenging time for us all. We know that, and obviously the future, as Patrick has said, is quite unclear. The clients have made the best steps, and all we've done so far is to obviously support that and help them think outside the box of ways of taking the business forward and keeping themselves out of trouble. I don't know if that answers the question.
No, it's very interesting. I say only time will tell. Like we said, we're here as a practice to support all our clients and new ones as well to plan for that. You know, there's more guidance being released every day as to what's going to happen in that year's time when those monies are repayable, and all the steps that you as business owners again can take to you know, protect yourselves, protect the business at a later date. And Tina, would you say that business protection insurance or life insurance is still sort of a second thought to most business owners, and it should be sort of an automatic sort of, if I've got a loan, I should be protecting myself, especially if you're a sole trader, when you know you're exposing yourself to more personal risk?
Yeah, I would say that a lot of people don't really know about it, or if they don't know about it, they don't really understand it. And the first thought will be, oh, that's going to be really expensive. But in actual fact, it's not that expensive. And basically, you know, you wouldn't drive a car without insuring yourself, or you wouldn't have your home without insuring it, would you? So I think to insure your business, which is bringing in your money, is key. And to have borrowed the money that so many people have, as you can see from Justin's slides, you know, it needs to be protected, because if it's not protected, the consequences are absolutely massive. What everybody's actually worked for to build up, they would just lose. So it is actually a really key thing to actually look into doing.
Rebecca, I was just going to also say, I mean, sorry to interrupt, but in terms of planning, in terms of insurance, ultimately, a lot of the Bounceback loans are typically without personal guarantee. Sybil's, if you borrow up to 250, as I've said, is without a personal guarantee. But if it all failed and the liquidator sat down and said, well, what measures have you taken to ensure the company has traded correctly, has been correctly funded, managed, run? You've looked at have you interrogated your people that you're supplying the goods to make sure, what steps have you taken, including insurance? If you can demonstrate to them that you have been diligent and you have applied a plan, you have a detailed plan, you have structured cash flows that show methodology, that show understanding, that show the desire to protect the firm, In addition to that, you've put key insurance in place to cover you for specific members of the business that play a key role in the business should they unfortunately pass away. Or it's, as Tina says, it's like having insurance in car. Yes, it's all year you have the car insured, you don't claim. It's when it happens, you're grateful for the fact that you paid your £380 for your car insurance. That's when it really counts. So I think, again, the whole purpose of this future proofing is to be able to show that you've planned will be a long-term benefit as well. You're investing some of the money you've borrowed in your own future and those of the people directly around you who matter the most, and indeed the business. So yeah, sorry, so that was my point. It was basically there's a good argument for the investment of funds and investment of time and making sure you have a plan. Patrick, I'm sure you probably
Yeah,
agree.
I was just going to add to that, saying as you go on in business, you want to be ideally building up a picture of yourself that's publicly visible or can be made available. Building up a picture of the business as being substantial, reliable and responsible. So, and that does usually mean building up, showing you what protections you have in place in terms of your insurances, what plans you have in place, and obviously your historical data and past accounts and all that. And that's what we do when we work with people on growth plans to try and grow the businesses, to show, because you may, if you're really growing the business to attract investment, if you want to take it up to the next level, then you're going to have to show those people that you know what you're doing and you are a responsible business owner. And what Justin just said, that's going to pay into that. If you're not looking to go in with investors, you're just looking to grow the business, then you might be trying to demonstrate that to a bank, to a lender. So it's just important to be able to build up a picture of you as a business owner and the business as something that is not just fly by the seat of your pants, but actually trying to do things, properly and responsibly. So this is where all this stuff comes in.
Wonderful, thank you. We're just about out of time for today, but again, thank you for Tina for going through it all about protection and how to insure your business and different areas of the business as covered, for not just anything about loans, but again about those key people involved there. Thanks to Patrick again, looking at why you should plan and how to plan. I know we didn't cover in detail the tools that we use here at Farnell Clarke to look at forecasting and budgeting, but again, please reach out to Patrick if that's of interest to yourselves. And thank you again to Justin, talking about all things funding. And again, if you've got any questions about the funding that you've already got in place or any future funding, then please do reach out to him. Yeah. But thank you all for joining us today, and we'll see you soon on one of our next webinars.